If you are over the age of 60 and you have a bank account, a retirement fund, or a social security check coming in every month, then what I am about to share with you in the next few minutes could literally save you thousands of dollars. I am not exaggerating. Right now, in 2026, there are 5 specific things that seniors and retirees are still doing at the bank that are quietly triggering IRS scrutiny, generating unnecessary tax bills, and in some cases, causing people to lose a portion of their Social Security benefits without even knowing why. These are not obscure loopholes or complicated legal strategies. These are everyday banking habits that millions of Americans over 60 are doing right now, habits that made perfect sense years ago but have become financial landmines under the new rules in place today. So stay with me all the way through this because I promise you by the time we get to number 3, you are going to want to pick up the phone and call your bank. Over the past 2 years, the IRS has dramatically expanded its financial monitoring infrastructure. Under updated Treasury Department reporting requirements, banks and financial institutions are now required to report a much wider range of account activity directly to the IRS. We are not just talking about large wire transfers anymore. We are talking about patterns of deposits, withdrawals, and transfers that the IRS's automated systems flag as potentially suspicious or as indicators of unreported income. The IRS does not have to audit you to penalize you. In many cases, an automated mismatch between what your bank reports and what appears on your tax return is enough to trigger a letter. And that letter can come with interest, penalties, and a demand for back taxes that goes back 3 years or more. Now, before I get into the 5 specific things you need to stop doing, I want you to understand who is most at risk here. It is not the wealthy. It is not people with complex investment portfolios and teams of accountants. It is ordinary retired Americans, people living on fixed incomes, people who have been managing their money the same way for 20 or 30 years. People who are not trying to cheat anyone, but who simply have not been told that the rules changed. If that sounds like you or someone you love, this video is for you. And I want you to keep watching because what's coming up at number 2 and number 4 is something almost nobody is talking about. And it could be the most important financial information you hear all year. The first thing you need to stop doing at the bank right now is making regular cash deposits just under the $10,000 reporting threshold. This practice is called structuring, and it has been illegal under federal law for decades. But what has changed in 2026 is the enforcement. The IRS and FinCEN, that is the Financial Crimes Enforcement Network, have updated their detection algorithms to flag patterns of deposits in the $8,000 to $9,500 range, especially when they happen on a regular schedule. Here is a real example. Imagine a retired gentleman named Harold who sells a piece of farm equipment and receives $12,000 in cash. He thinks he is being smart by depositing $9,000 one week and $3,000 the next to avoid triggering a report. What Harold does not know is that even this 2-part deposit pattern can now be flagged as structuring, which is a federal offense that carries penalties of up to $250,000 and even potential asset forfeiture, regardless of whether the underlying money was legitimate. If you have ever split up deposits to stay under any threshold, stop immediately and speak with a tax professional. The IRS is not giving warnings on this one. The second thing you need to stop doing is keeping large sums of money in a standard savings account without understanding how the interest is reported. This sounds simple, but here is where seniors are getting caught. In 2026, interest rates on savings accounts are significantly higher than they were just a few years ago. Many banks are offering 3, 4, even 5% on high-yield savings products. That means if you have $200,000 sitting in a savings account, money you worked your whole life to save, you could be earning $8,000 to $10,000 a year in interest, and every single dollar of that interest is taxable as ordinary income. It gets reported on a 1099-INT form that goes directly to the IRS. The problem is not the interest itself. The problem is that many seniors are not reporting it correctly on their tax returns, or they are not accounting for it when calculating whether their Social Security benefits will be taxed. Yes, you heard that right. Bank interest income can push your combined income over the threshold that causes up to 85% of your Social Security benefits to become taxable. For a married couple, that threshold is currently $32,000 of combined income per year. If your Social Security plus your pension plus your bank interest exceeds that number, you may owe taxes on a chunk of the Social Security you thought was tax-free. This is one of the most common and most painful surprises for retirees, and it is happening right now to people who have no idea it is coming. If you are finding this information helpful, I want to ask you to take just 2 seconds right now and hit that like button. And if you have not already subscribed to this channel, please do that now. Every week we bring you updates exactly like this one, plain English explanations of IRS changes, Social Security rules, Medicare updates, and retirement strategies that directly affect your financial life. Subscribing is free and it could be worth thousands of dollars to you over the coming years. Now let's keep going because we are not even halfway through and what is coming next is something you really cannot afford to miss. The third thing you need to stop doing is making frequent person-to-person transfers or Zelle and Venmo payments without understanding how they are now tracked. This is a huge one for seniors who are helping out their adult children or grandchildren. Starting in tax year 2024 and continuing through 2026 and beyond, the IRS lowered the reporting threshold for third-party payment platforms to just $600 per year. That means if you sent your granddaughter money for college, helped your son with a car payment, or regularly transferred funds to a family member using any digital payment platform, those transactions have very likely been reported to the IRS. Now, gifts between family members are generally not taxable to the recipient, and you as the sender are allowed to give up to $18,000 per person per year in 2026 without triggering a gift tax filing requirement. But here's the problem. The IRS does not automatically know these are gifts. If your bank or payment platform reports a pattern of outgoing transfers and there is no corresponding documentation, the IRS may treat those transfers as income to the recipient or flag your account for review. The solution is simple, but most people skip it. Keep records. Write a short note or keep a simple log that says, gift to granddaughter, birthday 2026, $2,000. It takes 60 seconds and it protects you completely. But if you have been making these transfers for years without any documentation, it is time to sit down with a tax professional and review the last 3 years of transactions. The fourth thing seniors need to stop doing at the bank is leaving beneficiary designations outdated or blank. Now, you might be wondering what a beneficiary designation has to do with the IRS. Quite a lot, actually. When you pass away, the assets in your bank accounts, your IRAs, your 401k plans, and your annuities do not automatically go to the people named in your will. They go to whoever is listed as the beneficiary on each individual account. If that beneficiary designation is outdated, naming an ex-spouse, a deceased relative, or no one at all, those assets may go through probate, which is a public legal process that is slow, expensive, and generates tax events. More importantly, for living seniors, if you are the beneficiary on someone else's account and you receive a large inheritance, the way that money is structured and the timing of its distribution can have major tax consequences in the year you receive it. In 2026, inherited IRA rules in particular are stricter than they have ever been. Non-spouse beneficiaries are now required under the Secure Act 2.0 rules to fully withdraw inherited IRA funds within 10 years, and those withdrawals are taxed as ordinary income in the year they are taken. A $300,000 inherited IRA distributed over 10 years means $30,000 of extra taxable income per year, enough to affect your Medicare Part B premiums, your Social Security taxation, and your overall tax bracket. Go to your bank this week, ask to review every beneficiary designation on every account you own, and make sure it reflects your actual wishes and your current family situation. The fifth and final thing you need to stop doing is ignoring required minimum distributions, or RMDs. If you have a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts, the IRS requires you to start withdrawing a minimum amount each year once you reach a certain age. Under the current rules shaped by Secure Act 2.0, that age is now 73 for most people. If you turn 73 in 2026 and you have not yet taken your first RMD, you need to act before December 31st of this year. The penalty for missing an RMD is severe, up to 25% of the amount you should have withdrawn. On a $400,000 IRA, the first RMD might be around $15,000 to $16,000. Miss it and you could owe a penalty of nearly $4,000 on top of the taxes you would have paid anyway. What makes this worse is that many people do not realize they have multiple accounts, each with its own RMD calculation. A bank savings IRA, a rollover IRA from an old job, and an inherited IRA all have separate rules and separate deadlines. Your bank is not required to remind you. Your brokerage is not required to calculate it for you automatically. The responsibility is yours, and the IRS will hold you to it. None of these 5 mistakes require bad intentions to trigger. They are not things that dishonest people do. They are things that perfectly honest, hardworking retired Americans do every single day simply because no one told them the rules changed. The IRS's systems are more sophisticated than ever in 2026. Banks are reporting more data than ever before, and the gap between what seniors know and what the government knows about their finances has never been wider. That gap is what costs people thousands of dollars. Not fraud, not cheating, just a lack of updated information. First, call your bank and review your account activity for any deposit patterns that might look like structuring. Second, check your 1099-INT forms and calculate whether your interest income is pushing your Social Security into taxable territory. Third, review the last 12 months of any digital transfers you made and make sure you have documentation for gifts to family members. Fourth, update every beneficiary designation on every account you own. And fifth, if you are 73 or older, confirm with your financial institution that your required minimum distribution for this year has been calculated and scheduled. If you found this information valuable, and I truly hope you did, please subscribe to this channel right now. We publish updates like this every single week because the rules keep changing, and you deserve to know what those changes mean for your money, your retirement, and your family. Hit the subscribe button, turn on notifications, and share this video with a friend or family member who is retired or getting close to it.